Hooper, 21 years veteran. He's CEO of Atlantic Logistics in Jacksonville, Florida. And he's going to talk about market update and trucking updates. Thank
you. God works in mysterious ways. I prepared a presentation a couple weeks ago for a brick forum that was going to be in Jacksonville, Florida, and there was a fire in the hotel, and the weekend before they canceled it, so I prepared a whole bunch of stuff. So there's some stuff in here that won't be pertinent, and brick forum's obviously not pertinent, but I'm Rob Hooper, CEO of Atlantic Logistics. Before coming to the family business in 2003, I had earned a PhD in economics. I was also a college pastor. And so I sort of put everything together and now run a company and do the economics and all that. And it's exciting to be able to put this stuff together. Our Atlantic Logistics is a non-asset 3PL based in Jacksonville, Florida. We do shipments all over the US, Canada, Mexico. We are a freight broker. We're a middle person between your freight and carriers that contract for that freight. So we have a keen interest in how the market is going, what is happening with the economy, and our values are integrity. We're family oriented, we're family owned business, third generation working there, exceptional service and innovative. And so just a quick overview of the economy. The economy, the GDP, is the biggest measure of global domestic product, and you can see here the massive dip. This will be a blip in history that will mess up all sorts of graphs over time, but you can see the growth going along fairly steadily, the shutdown from COVID, and then the year-over-year boost and the pandemic money that went in that shot production up dramatically over the next year. And then you can see where we are right now up into 2024. These numbers here are projections by the Federal Reserve Summary of Economic Projections, SEP. It's a quarterly report, and these estimates are what the Fed presidents and the Board of Governors members vote on or project will happen this next year. As you can see, here's zero, this line right here, and the big question has been, will there be a recession? The Fed is projecting not, and a lot of financial analysts are projecting not, that the Fed has done one of the elusive soft landings, that they've been trying to kill inflation. The Fed has two purposes, two main goals, the inflation and full employment. Those are the two foci of the Fed. And so when inflation got out of control, they had to do something about it, even if it does damage to the overall economy. Always weighing against that, what happens with unemployment. But you can see the focus, or the projections there, are that it stays positive. This is a slide. I'm part, one of my old thesis advisors is a part of FTR. You connected with FTR in Bloomington, Indiana. That's where I went to school, Indiana University. And they're a research group. If you ever need analytics on markets, rail, transportation, all that, I highly recommend it. They graciously gave me permission to use their slides, and so this is one of their slides. And you can see this, and it's a little bit easier to see the growth and the drop around the pandemic, and then where we've been. We're still positive. Now, this makeup is a big switch in goods and services that occurred during the pandemic, which I'll show you in a second. But here's what their forecast is: 1.5, 1.2, 1.5, 1.9%. So that's good news for the economy. And then the unemployment rate, again, the big blip that won't go away. And then you can see the projection here. Unemployment has been coming down. Fed essentially hitting a full employment goal in their policy, and combined with the fiscal policy and the macroeconomy. And then you can see there's a projection here of increased unemployment over the next year. Now, here is what happened. This is, from an economist's perspective, and just what happened with all the supply chains during during the pandemic. It is, you can see that here's the green one is the services going along here, just bumping along, and then services plummeted when the pandemic happened, as restaurants, everything shut, your pedicure, your whatever, your hair salons, all that stuff shut down, and it collapsed significantly. I mean, that's a $2 trillion drop, or $1.5 trillion drop in spending, which is fairly significant. And then you can see here's goods right here. It dropped some, but then quickly recovered. And then as the pandemic money, the PPP money went into the economy, you had a surge of people going to home supply stores, Home Depot, Lowe's, all that, the spending, pavers, all it went up. And you can still see, we're about back on par here, and we're getting back to about the trend line where you would have been before. Consumption's the biggest driver in the economy, and obviously a very important measure. Consumer leverage over the past few years, you can see here that household debt percent of disposable personal income, it plummeted as all the money transfers happened during the pandemic. A lot of people paid off debt. A lot of people were very frugal. You can see that same pattern here as credit card delinquency rates went down. And then you can see they're starting to go back up here to 3%. And then the other blip in the map is the Great Recession. That was, a very difficult time in our industry. It was like a 4-year glacial slide, and I'm sure many of y'all had that same impact in your industries and businesses and your families. It was a very difficult time. But you can see that the consumers are in a pretty good place, and they're the major drivers of the economy. And here's just another measure of the bottom 50% of wealth, how it changed during the pandemic, and the big shoot up in cash as the wealth transfers occurred through the pandemic money that was distributed. And this is the other 50 to 90th percentile, still a big jump. But there was a huge impact. Here over here, you're talking 5 trillion. Here you're in 800 billion. So there's scales significantly different, obviously, for the bottom 50% and the 50 to 90th percentiles. The inventories to sales ratios, this is one of the major drivers of what's been happening in the economy during the pandemic. And since then, you had wholesale inventories to sale and the retail. You can see both again, the big blips that occurred here. And so you just sort of go past that, but then you can see that inventories dropped, and then all of a sudden last 2 years started accumulating greatly. And that's when there's been significant changes in the trucking industry as a result of this change right here. As inventories super accumulated, buying patterns has changed dramatically. And then just another major driver in the economy is industrial production. You can see these are some bad signs here, negative. This has been impact for us in terms of freight throughout the country. You see negative 3.1% in the last quarter. Even though overall the economy is doing well, there are segments that have been greatly affected. You've probably seen stories on why do consumers feel so bad? Well, you have the high price of eggs and the money that you're spending at the store, but you also have areas of the industry which have been unevenly affected by the changes and the sort of the whiplash that we've had over the last couple of years with the shortages, then the surpluses, and all that. And this is GDP for the good transport sector has, you have the collapse when everything shut down, military everything. We do military shipments. The bases were only essentialities for about a month, 6 weeks, as the pandemic was unfolding and people were trying to decide what was going to happen. And then a lot of people made very quick decisions during that point in the trucking industry, and then quickly tried to unravel those because there was a torrent. You see this is down 40%, and then it was up 50% right after that. So that's still a net positive switch. And then for the next 2 years, it was very positive, and then has gone negative. And then the projections are we're going more positive in 2024, which is a good sign for the freight sector. Now, I'm gonna blitz through these just real quickly because these are construction. I don't think y'all really care about the construction spending, but you can see it's gone up. Privately owned homes is geared towards the brick industry, and that. Homes have plateaued over the last year and a half, 2 years of newly privately constructed homes, and residential construction. Forecasting a recovery. Brian, you talked about the interest rates. Here is the driver of interest rates. The Fed drives the interest rates in the economy through the federal funds rate, and this period here, is an unprecedented time where you have essentially a 0% federal funds rate, which is what the money that the Fed loans money out to banks, and then that gets transferred out to us as citizens and consumers through our bank loans or home loans, interest rates, and all that. And then as the transit, you may remember if you're into it, everything was spoken of about transitory shocks. That the inflation's transitory, and I actually got term limited off on the Atlanta Federal Reserve Transportation and Logistics Advisory Council. So they meet. It's really fascinating, how they do work. They meet with people in the industry. CSX is on it because and for the Atlanta Fed, CSX, Landstar. I was on it just probably because of my background. And Raphael Bostic, the head of the Fed, we were sitting there and he said, I think this is transitory. We were at lunch as the inflation's hitting up, and everybody thought that it was just going to be a blip, and then it just kept going and kept going and kept going. And so they screwed up. The Fed screwed up and responding too late because they thought that the inflation that was experiencing was just supply chain issues, and there were significant supply chain issues. I'm sure all of y'all experienced it with anything that you were trying to get. If you were trying to buy something through Amazon, you were trying to get toilet paper, you were trying to get whatever it was during that time, you felt that pain of the supply chain issues. You saw the images. Logistics became sort of cool for a while because you'd see the ships off of LA Long Beach, right? You'd see them all out there harbored, and you'd have reports on the nightly news, and it's like, wow, somebody cares about what we do. It became significant. Well, you have here the Fed trying to catch up, and they ratchet, and now they're holding. And they held the last meeting, and here is, again, the SEP. These are the forecast. Brian mentioned, the forecast is for decreased rates, and so the rates are coming down, and I lost my slide here, so I can't read you the exact number. I think it was 4.33% for this next year, or 4.25%, and we're at 5.33 effective funds rate right now. So there should be relief for your capital expenditures. That should drop your costs. For your home mortgages, you should start seeing some relief in those areas over the next year and two. And here's the mortgage rates. What happened? They were down, and then they just got crazy, very expensive. And then you saw as interest rates went up dramatically, nobody wanted to sell their home, or you only sold your home if you had to because you got relocated or whatever. And then so the housing stock of existing homes, has constricted dramatically over over this period as the interest rates went up. Because I got a 3% mortgage. Why I'm going to go get a 7% mortgage? I can only afford significantly less of a home. Trucking, quickly. Total truckloads. This is again an FTR graph, which is again appreciative for them sharing. But you can see the truckload shipments over time. Again, the big collapse in 2020 with the pandemic. But again, if you go along here, you can just see it sort of bleeps along, and then it picked up significantly. It's 66 million total truckload shipped by the shipment index, and then the change in that over time. But then you can see here, it's been pretty bleak for the last year. So what happened was during the pandemic, as everybody switched, that graph where everybody switched to goods and services collapsed, and everybody wanted to buy all their goods. All the ships were backed up, all the trucks were backed up, all the warehouses were full, everything was boxed up. And so that's changed, and that changed about last April. And what now people are calling, this has been one of the longest freight recessions that has occurred. What happened during the pandemic couldn't be sustained, obviously, and then when spending habits resumed to more normal patterns, that's been unraveled, and this will become clearer in here. Net change in carrier population. These are new for hire property authority minus net revocation. So when you get your authority, and there's a little bit of a lag on these numbers, but when you get your authority to become a trucking company, you have to register with the Federal Motor Carrier Safety Administration. And so this is measuring the net positive ones minus the people who have their authority revoked because they didn't renew their insurance, didn't do their form correctly, or they just got out of the industry. And you can see the scale of the numbers here. During the Great Recession, during the pandemic, during the pandemic, as trucking prices went through the roof and you were paying more for everything, and that did flow through the supply chain and cost and inflation and all that, you're talking about 20,000 quarterly net positive companies coming in. Now, some of this is shifting. So the Knight-Swifts, the big trucks that you see out there on the roads, if you ever see them. Once you're in the industry, you see them all. But the big companies that exist out there, a lot of those drivers left and went and created their own company and be an owner-operator and run their own small business. And so some of this is a shift of that. But these are net 20,000, and then you can see here from the last year, the last year and a quarter, that we've been negative 5,000, 5,000, 7,500 here. But you can see this nowhere compares to how many trucks came in. So we're in the middle of a freight recession, and that's mainly a factor of all these trucks that came in, these owner-operators, small business people that came in to start a company, and they're holding on. I did ask Avery at the last session that he did for the FTR, and I asked him, I said, do you think that this is partially a function of what we saw in the wealth and income, that people are in a very good position right now, and so they're holding on even though the rates have plummeted? And he said that seems very plausible, that because they're not highly leveraged, they're able to go ahead and withstand this downturn that's been going on with the hope that the rates are going to come up. Rates are starting to firm up, and we're starting to see some firmness in the rates. Now, here is the active truck utilization. This is a fascinating, again, you see the blip here with the pandemic. Here's a 10-year average at 92% is your average truck utilization. So you're using 92% of the trucks that are out there at a given time. And then during the switch to goods, you're at 100% plus. everything was being used, which is what you saw and felt in your prices, and then it just, collapsed. The people come in and come out pretty quickly, though they're not leaving as quickly as you would expect. And this is, well, this right in this area is good for the economy. You don't want your truckers starving, but you also don't want to be at 100% where you're going to pay a lot more for your freight and getting your hauling done for your products or your recycling and all that. But this is the forecast. We're getting back into a better position over the next year and a half. So it's not going to be a speedy recovery for the freight side, but this means you have capacity to move your product. You should find it easier to get drivers. You should be able to have more on-time service deliveries for your product. And this is what happened with this is contract rates over time from 2017 on. You can see that the truckload rates were sort of slowing down over the period before the pandemic, and then the contract rates. Contract rates are usually a longer period of rates, last for a year generally, could be longer with benchmark moves based on fuel and market conditions, but they tend to move very slowly and less variable, and you can see they shot up. This is an index over here, 160 from the base of 2008, and then they've been coming down, and now they're starting to firm back up is the projection for the next year. Now, a lot of the stuff happens in the spot rate. This is where we dwell mainly, is in the spot sector, and you can ride the wave, the collapse, and then it took up to 170, same base of 100 in 2008 here, and then the down the mountain from here. This was not sustainable, nor was it good for the economy. We need to get into a better position, so hopefully this next year there will be sort of parity in the market, and you won't. You'll be able to get trucks, but it won't cost you too much, and there'll be some stability. The flatbed spot rates, this is 10-year mark is $2.35 a mile, and you can see where we were, $1 over, and now we're back into sort of a place of position. Now, unfortunately, this insurance rates have gone up dramatically. So there's some things in here, and their borrowing rates are up, and so this isn't necessarily where you would want to be for long-term stability, given those factors of increased cost and the low unemployment and the higher pay. So that's not necessarily a sustainable level. And just quickly, rail. The rail forecast has been negative. As trucking rates plummet, people will shift away from rail. They shifted greatly to rail during the pandemic because they couldn't get trucks, and they said, okay, we'll take the rail, which is slower, it's more efficient, it's more carbon friendly, but it also takes longer. Cars don't show up. A truck you can get, and you can get them quickly, and it can get there, which was needed when everybody was trying to get the goods as quickly as possible. But it shifted. But there is a forecast for year-over-year change. And revenue per ton mile is going up. And then this, and again, this is from FTR, so this is their forecast. Millions of loads originated. They're forecasting continued increase in the rail, and that's it.
Thank you, Rob. Normally after these presentations, we open the floor up for questions. So if there's any questions, y'all, for either one of these guys. I did want to ask you one thing. I mean, I'm sitting here, doesn't fuel have something to do with trucking too? I mean, is that,
absolutely.
I mean, that's, I mean, how does that affect it? I mean, that,
Absolutely. Fuel is a very big component of the trucking prices. We saw the fuel prices run up. They've been mediating, coming down over the past year as global economies have slowed down, as they tried to grapple with the inflation and have been trying to dampen the growth. It's a very big component for the truckers and well,
and rail probably, rail too.
Typically, when you're looking at a rail move, you're looking at almost a radius. So when you've got your fuel prices that are spiking, you'll see that radius shrink. We typically use a planning of roughly 300 to 500 miles. So when fuel prices drop, you're going to push out to where your economics work out for rail right about that 500-mile mark. When the fuel prices spike, it's going to bring it closer into the 300. So it's going to have an impact on your cost of freight, but your per ton rate on your fuel surcharges are going to be greatly reduced compared to truck.
Yes, sir.
Rob, I have a question for you. One of the last slides you were showing, or you were saying that the insurance rates went up. Why did that happen? Not questioning it, why it, but
Sure.
I found it interesting why.
The main, there's a couple reasons. One is, it's particularly poignant here in Florida, lack of tort reform for lawsuits. There are what is called nuclear verdicts. There has been a verdict of, I think it was $1 billion, $1 billion with a B, and a tragic crash, and so that's driving up the insurance rates and making it more expensive as people prepare. The insurance companies and the drivers are being required to prepare for these nuclear verdicts. The other one is there have been a lot of scams. There have been cases in Louisiana and Texas where people, and it's hard to catch. They're setting up crashes involving trucks. And this happens with cars in South Florida, that they set up a crash and then they sue. And so it's a shame. But it's just a fact of the life, and there does need to be, in my opinion, some reform of the insurance industry nationally, but it's done state by state, so that needs to happen.
Okay.
So, 30-plus year veteran of the insurance industry. I have to have insurance too, so believe me, I can do things. And you're spot on, Rob, with what you're saying about the tort reform. Also, there's some capacity issues in the industry right now. They're running out of capacity. The insurance companies are, so they've raised the rates at that point. I don't use this word very often, but I have never in my career talked to people about how they vote. But I would encourage everyone, regardless of state, is state regulated, to pay close attention to your state legislators' elections, because that's where the insurance court reform comes from, and they regulate the rates that way too. And a lot of the legislators don't know how insurance works, and so they just kind of go with the prevailing wind, and we end up in trouble. And even though in the state of Florida we passed tort reform 2 cycles ago, it's going to take 2 or 3 cycles for the insurance to catch up to the tort reform that was passed. So get involved in your local elections. Rob is a fellow Jacksonville person, logistical capital of Southeast.
It is both truck and rail, right?
Shipping,
Yeah, shipping.
marine.
When you say insurance companies are running out of capacity, what do you mean by that?
Hang on.
Just for the conversation, we can pick on, everybody knows the red umbrella Travelers. You buy a policy from Travelers for a $10 million liability limit, they're not on the whole $10 million. They cede a lot of that off to what's called the reinsurance market. And the reinsurance market is shrinking over the years as well. So if travelers can buy more reinsurance, it's more expensive. And that all gets passed down to us. And so that's when we say lack of capacity, that's it, because they're paying. Insurance is literally a worldwide market. So when we lose a North Sea oil rig, or the earthquake and tsunami in Thailand, and the Exxon Valdez and the Deepwater Horizon, things like that affect the global insurance market. And so that's where it comes back down.
Thank you.
Sure.
Any other questions? Oh, here you go. Come on, Gene, let's go.
I'm making Gene run way too early in the morning. Thanks. So can both of you guys maybe talk a little bit on like the near-term future of moving recyclables by rail, you know, or because a lot of certain recyclable locations don't necessarily have rail access to their MRF, so there'll still be a trucking component involved. But, you know, for moving commodities, especially lower, you know, value commodities, like some of the lower value plastics and things, you know, to the places like KW and stuff here in Alabama, it's just logistically can't happen via truck alone. Can you guys talk to that a little bit, what you guys are seeing in maybe the next 5 years for that?
We're seeing a big shift in some of the railroads and some of the class ones and their ability to service. You have Joe Hendricks, which just came on. There's some talk about some changes at Norfolk Southern. The railroads are going to drive a lot of that movement of goods onto their platform, but they have to be willing to do it. If they're going to invest in a switch, current switch costs are, if I remember my conversation I had a couple of weeks ago, a mainline switch now costs $2.something million, $2.4 million. A rail car went from, call it $85,000 to $150,000. So if the railroads are going to invest in bringing locations on, it's got to have sustainability. So we're seeing some moves towards a more sustainable lift pattern, more projected forecast, and a willingness to shift from a model to where their only desired freight is the higher margin freight to more of a service pattern that's going to allow them to hit commodities that have a, call it a lower margin, lower threshold for cost. And with that shift, you've also got some market dynamics that are happening. We are working with some of the major plastic pellet companies. Can't really say that it starts with an E and then has an M somewhere in the middle, but you know, companies such as this, which are the massive producers of virgin plastic pellet resin, they're looking at some of these new initiatives they're taking on. There are some states that are calling for a 30% recycled plastic content in new resin. Well, when you look at where plastics, and I'm preaching to the choir here, but your waste streams are coming from the Northeast, from the Southeast, from Chicago, from the West Coast, whereas most of your resin production happens in the Gulf Coast. So to get it economically one way or the other, it's going to be driven by how can we lift it and how can we lift it efficiently. So MSW and C&D were forced into rail because of the movement of the landfills, and they couldn't get more trucks into New York City or some of these denser urban locations. And the scrap metal was a large driver of that, was getting the metal to the port and being more flexible with how much they could move where. But I think that what you're going to see in the next 5 years is you're going to see a development of how do we move plastic, recycled plastic. Do we how do we package it? How do we move it? What kind of cars? And get it to where the main plastic producer locations are. So that's something that we're focused on and we're seeing a shift towards.
Great answer.
On? Okay. It's been a long time since we shipped recyclables in boxcars, baled material. What is the cost of a spur, maintaining a spur on a rail line? It's been since probably the late 80s that we did this. Of course, trucking got so easy. It was easy to go on trucking compared to loading a rail car.
It's really going to range on the type of rail access. If you're on a main line, like I said, a powered switch can cost you $2.5 million roughly, putting it in and everything else. If you're on, say, a short line railroad and you just need to upgrade your switch, that could be a few $100,000. As far as rail infrastructure, I'm not an expert, but I'm just pulling out of friends of mine that have talked to me about it over the last few years. The best thing to do is to determine who owns the rail that you're on, and then that will drive a lot of what your cost structure is going to be.
That could be about $15,000 to $20,000 a month, and it was just not acceptable compared to shipping with the rail and shipping with the trucks as trucking became easy.
Like I said, it's going to depend if you're on a short line, if you're on a, call it a main line class 1, if you're on a spur for a class 1. All these things are going to drive your cost, and that's going to vary greatly depending on what you have to do and what they're requesting. What I've seen is that if, I think you mentioned that this was the 80s that you're referencing, there's been a large change. There was a Staggers Act, which brought a lot of consolidation in the rail industry, which means that a lot of that maintenance may not be on you anymore. It may be that the railroads are going to do that, but once again, I go back to, it depends on who owns that track in front of your location.
Thanks.
You mentioned a 500-mile radius. Could you unpack that a little bit? You said it's tied to fuel. Is there a sweet spot? Is it as soon as you hit 500 miles, you want to be rail, or you can beat trucks?
It's all going to depend on the economics. As I said, we designed a 8,000 plus cubic foot gondola, and those folks are moving that waste 85 miles, but they can't get trucks into the receiving or the, not my customer, so not 100% clear on it, but they can't get trucks into that. So for them, 85 miles is worth the rail investment, where I have other people that will truck across country because of timing of delivery. So it's a broad combination of factors on what you're doing. We've seen, as I was mentioning, we've seen scrap metal players that they're moving auto fluff. They're moving a very light product, and so for them, getting the trucks and that haulage means that their radius is going to be larger than, say, what somebody that's moving more dense steel is willing to accept. And I think that 3 to 5 is just a rough rule of thumb planning radius, but it's also going to change with the cost of trucking. As that moves up and down, that's going to change that radius. So if you take a look at it from a long-term perspective, it's just a planning figure, and it depends on what you're trying to access. Because if you're, let's call it 150 miles from the Port of Savannah, your cost may be different than, say, somebody that's moving into a port along the Gulf Coast. And so their radius may be that rail is the best way to access it economically into Savannah because of the dwell time on the trucks and the lag. Whereas if you have somebody that's 300 miles away that's further down the coast and has access into, call it Lake Charles or one of the ports, Baton Rouge or New Orleans, that may work better for them. Sorry to be so vague, I make rail cars.
Any more questions?
Hearing none, thank you, Pam. Thank you, Sid.
Thank
you,
you.
Rob.
Thank you.